Hello traders, Gary Wagner at The Gold Forecast. It is Friday, the 15th day of October, and this is the Daily Report, our weekend review. Gold is currently trading under pressure, down about $15, $15 to $16, currently trading at $13.65. It's approximately 8 a.m. with about 3 hours of trading left in the market. We're going to try to do this quickly because I do have a market order that I do want you to consider placing, and that is pulling profits in our long position. Let's go to the board and talk about what we're seeing. Yesterday, for those of you recall, we took a look at the possibility, which at this point is a reality, that we had hit some superlative resistance. Now, how did I come to that conclusion? Well, when you realize that when you're at these record tops, any of these oscillators aren't going to work. We've got a couple of things that are going for us. One, we had basic projections based upon Elliott Wave that told us to look for around the $1,400 area. In terms of the candlesticks themselves, until today, and we'll talk about the pattern in a little bit, but until today, there really wasn't any sign, weekly or daily charts, that showed us that we were possibly hitting a top. Over the weekend, though, I ran a basic technique called an Andrews pitchfork, and I'm going to go ahead and draw that in for you here. What I did is I based it upon the two lows, which would be the bottom of C, in other words, the bottom of the corrective phase. So I started here. This is that 1040 point in February. I use that as my first calculation point. And then I extend that to the second correction, which took place right before the end of July, and that gives us our second data point. All right? For our third data point, I carry this pitchfork up and put it to our top of wave 5, and that gives us our Andrews pitchfork. Now, here's what I found was quite amazing. When I did that, what I saw was that when we extend this upper line, and you can really draw it from 3 to 5, the tops, and then kind of extend it, that's going to be our upper level resistance line. Follow me with this here, traders. So as we took a look at it, and it actually came close to that, depending on where you put these data points, it's going to come right to or right there. So what I saw yesterday was, in fact, that we hit this, and then during the day, we had a candle that's basically called a shooting star. Now, a shooting star to me is one of the stronger one-day candlesticks as we have seen them before, and they have absolutely signaled tops in the market. We have one right here, but in essence what it is it's the opposite of a hammer. You get this, call it a small body, and then you get a larger tail. And this, in essence, this is your shooting star here. Now, why is that candle so significant? Well, when you consider it this way, in this, you have your open and your close. So the market opens, and at some point, the bulls, which are still in control of the market, take that market up, test, go to a higher high. In this case, actually went to a record high when it hit that 1388. I keep trying to say 12, but I have to realize. So when it hit that 1388, what happened was at that point you then get major profit taking, and you're actually able to see that profit taking drive all of those gains down, come to the close, and then close below the close. Now, in the umbrella candles, the body, color body, is not as significant. It can be either in terms of body color, but black, meaning a lower close compared to the open, I think is quite stronger. So when we had that combination of the shooting star, and we had this Andrews pitchfork that showed me that we really kind of butt up against resistance right in here. And when I coupled that with the fact that I was looking for about 1400, that's a 1.61 move of wave 1, I felt that there was, at least in my opinion, the ability for, if the market wanted to retrace, it was a logical point for me. So we simply looked at that, and today we did have the market kind of transition And it did transition, as I said, into this sell. And so what we're getting is we're getting this engulfing bearish, which of course needs to be a 3-day pattern. This is only the second day. However, I'm not using this right now as a sell signal. What I am using this as is a additional piece of information that's telling me that a retracement is probable and likely. The confirmation on that would be another, this would be Sunday and Monday's activity. You would have to have a black candle, lower high, lower close, lower low. And that would be an indication that, in fact, the market wants to retrace. Now, I did plot out some basic retracement areas before, but they were based on the market going to 1400, which, of course, it appears as though 1388 has been our bottom. So if we do a basic Fibonacci retracement from the third wave, which starts right in here at 1240, and we extend it to the top, which is going to be 1388, excuse me, that was 1340, we will then get our basic Fibonacci retracement numbers. Traders, let me put that in a little bit darker for us. Traders, I've gone ahead and added some potential levels for a Fibonacci retracement. The 23% retracement, if in fact this market wants to retrace, and traders, I'm not convinced that it has, but I feel pretty strongly about it. As you know, I came on and reported yesterday that we needed to move our stops up. What I am recommending is for conservative traders, let's take the money and run. Let's simply exit the trade. We're in at 1340. You'll get out at 1365, 1360. If the market continues higher, we'll buy the breakout. If the market continues lower, we'll buy the dip. Should we sell in this market? Now, you could get a nice retracement here. If, in fact, this market comes down more than 38% and it goes to for example, the 50% level, which is around, well, we'll calculate that in a second, but I personally am not a seller in this market. I'm not that comfortable being short in what I consider to be a super bull cycle. So, conservative traders, and in this case, I recommend it, go ahead and take that stop to the market. That's 1366. Aggressive traders, if you want to try to weather this out, you can do that, and we might see a turnaround. In other words, it is absolutely likely, because I know there's this buying the dip mentality, that this sell, that what we get here could be similar to here or similar to here. And this, remember, was the largest retracement we got. This is at 23% retracement level. Now, I actually got an email this morning that said, Gary, are you positive that we are in wave 3? The retracement that you've drawn is absolutely so shallow. Could we possibly be in wave 1? Well, could we? Absolutely. Fibonacci retracement is absolutely a science and an art. Elliott wave is absolutely a science and an art in terms of where the placement goes. But I have talked with a couple other Elliott wave technicians that I highly regard. And as hard as it is for me to fathom, when we take a look at it, and let me go ahead and darken this in 1 second. I've gone ahead and put this in, and as you can see, when you look at it, it does look very, very shallow. But when you look at it from a perspective of a Fibonacci retracement, it does come to 23%. It comes there quite eloquently, and so absolutely it can be labeled as that retracement wave. It's a full 23% retracement. So it is shallow, but realize one thing. It's shallow within what I'm calling a absolute super bull cycle. You've never had this kind of a wave or movement before. And because of that, I absolutely believe that you have to be cognizant and read these waves a little bit differently. Now, and that goes to show, look at this. When we had wave 5, 1221, that first record top here, you had this tremendous retracement. When you consider, in other words, the depth of that retracement off of this fifth wave, and by the way, this fifth wave was the largest of the waves, but when you look at it, it went a full 78% retraced of that wave. You then had a move here, which took it to 50%, and here, this took it just between the 78 and 100%, and that started this next, what we call complete cycle, which is waves 1 through C right in here. And this was that last cycle, which witnessed 2 tops. Now, what we've got is this Super Bull cycle. And the reason that I've labeled that is take a look at the way you have to do this wave count. Now, when doing a wave count, there are a couple of absolutes. The absolute that I always start with to verify and check my work is that the top of the market right here has got to be wave 5. Okay? That's absolutely certain. And then when you look for your correction, these C's must be the bottom in terms of a correction. So once you're given those 2 facts, you can then go ahead, kind of like a puzzle where you start by building the frame and then you kind of work your way in. That's kind of how I'll backtrack when I look at it to double check my work. There was no other way, and as you know, I started thinking that this was all wave A, and then realized that that simply wouldn't hold water as this market went up and in fact surpassed this B. I realized that I had to reevaluate the wave count. So there could be a point in which I look at this a little differently. However, as I look at the market right now, in my opinion, this wave count is true and it is absolutely accurate. Traders, we were 100% correct in entering at 1340. 1340 was a good point for us. If you look, what we had was that double bottom right in here. You had an engulfing bullish. You had your confirmation. It was absolutely correct. I, at this point, think it's correct to pull profits here also. Again, if I'm wrong and the market continues higher, we will buy the breakout. If the market continues lower, we will look for a combination of A, Fibonacci retracement points, B, candlestick signals to indicate where we believe the proper entry point is. Because what I am thinking is we still have one final wave to go, okay? And that one final wave typically will be about the same size as wave 1. So as you can see, this is a scalable, let me just make sure it's not locked, it's not. This is a scalable line. So if I take this line and I extend it, for example, I extend it from this retracement point, say 23% retracement point, meaning wave 1, wave 2 is our small correction. Here's our 23%. We'll assume this is under the assumption that wave 3 has concluded, making the next assumption that we get another shallow 23% retracement and then a $100 move. As you can see, my target is about 1460. 1460 is my target. Longer, not longer term, but let's call it by the end of the year. For gold, I think that it is also possible we will see a very shallow retracement. I'm not looking for hard corrections. I think that hard corrections only occur in a traditional cycle, and we have a absolutely bullish Super Bull cycle. And as long as we have that, this market, I believe, is destined higher. Wishing you, as always, good trading. And as we say in Honolulu, Hawaii, happy Aloha Friday. This has been Gary Wagner with the Gold Forecast. We'll talk to you on Sunday for the Daily Review. Remember, go ahead, conservative traders, cover your positions, pull profits. Bye-bye.